If your business is struggling due to the current global crisis, cost rises and inflation, then where can you turn for assistance? Debt and raising finance in your business. Have you been taught that debt is a dirty word and something which should be avoided? And have you been lectured in the past of the dangers of borrowing money and the importance of living a debt-free life? This is the employee mindset way of thinking, by the way. I'm here to tell you, as an entrepreneur, debt is actually your best friend, and that you should be leveraging this in order to create wealth for yourself and successfully grow your business, using other people's money to pay for your business growth and success. As you watch this video, you'll start to see what actions you can take now. Yes, now, in order to get ready to level up your business. So make sure you watch it all the way through to the end to ensure you capture every single one of those golden nuggets. Now let's take a fresh look at debt and show you how to use it strategically to achieve your goals and create long-term success. As an example, I get it. Interest rates at the moment are not as low as we've seen previously. But how can you go wrong? Borrowing, for example, say 200k and only having to pay back, say, 8% or so in interest. I mean, let's look at that again. You're going to give me 200k, and in return, I can repay you over 5 years, and you'll only want 8% in return for that. Just imagine what help that would bring to your business, whether that's investing in new machinery, buying new vehicles, or even having it there to fund growth and working capital. This strategy will ensure that you will not only survive this year, but you will look back at this year as the year that your company recorded record growth and set up the blueprint for success to get you and your business to the final destination of the wealth creation station. But before we get into this, don't forget to hit the like and subscribe button to this channel. Welcome friend, I'm Bradley, an entrepreneur who has previously helped grow a business from 12 million to 150 million, and now I run 5 separate successful businesses, and each of these companies is leveraging debt to grow and succeed. The main points we'll run through today are listed here somewhere, so let's kick off with this one. So firstly, why are we so scared of debt? And I think this comes down to a lack of education from a young age that we're not quite getting in our school system, a lack of personal finance in general, and also for businesses. For most people, our only introduction into debt is through our family and friends, and probably stories of a friend that's gone out, had a credit card, spent 20 grand on it, they've got into debt, all of a sudden they've got debt collectors on the phone, in trouble. And you know, this is kind of the stories that we're hearing all the time from friends and family, because we're not having that education around managing personal finance and how we can actually utilise debt to our advantage. And that's just one example, an extreme one as well, but once we hear stories like that from our friends and family, then that instills in our mind that, wow, debt is something that I need to be afraid of, and you know, I've got to be careful that, you know, I don't overspend or overcommit, because I could find myself in a lot of trouble later down the road if I can't afford to repay this debt. But as a business owner, we really want to be using debt to our advantage. It's a way of accelerating our growth and ensuring that we've got the working capital there to pay for not only staff and infrastructure and systems, but also we can leverage off of some asset-backed finance to get some assets into our business, whether that's tools, plant, machinery, vehicles, you name it. The debt's there to help fund it. So a lot of small business owners worry that they're not going to be able to generate the profits to be able to repay that debt, and they're not going to be able to meet the kind of monthly capital repayment requirements. And if we're using debt to plug a hole of profit, then yeah, that's when we can fall into danger. But if we're using debt correctly in our businesses, not to fund lost profits, but to use it for working capital and growth, then there shouldn't be an issue there. We should have sufficient profit that's going to cover those monthly repayments. So if you're borrowing money on behalf of your company, then generally it's just limited within that company. It's a limited liability. It doesn't affect you personally in majority of cases. What we're seeing now, because there's so much uncertainty, is that finance companies are giving loans to businesses still, but what they want is a personal guarantee. This way the lender's kind of got some assurance then that if the business fails or struggles, then they've kind of got some callback to the owner. This is kind of one of the reasons why a lot of business owners are worried now about taking on these loans, because they're just worried that all of a sudden they're going to lose their house or lose their car or lose some of their kind of personal assets. One way that we can get around this is by using a personal guarantee insurance policy, which, you know, for a very small sum of money kicks in. If the worst does happen, this policy would kick in and will repay the loan. So that's just one way of mitigating that risk, is by having this personal guarantee insurance. Another misconception a lot of small business owners have is that they would rather fund any kind of transactions or capital expenditure through their own working capital in the business. So they want to see the profits being generated, and with those profits, that's what they're going to use then to buy the equipment or the assets or take on new staff. Which, you know, it's a great philosophy to have, but the danger is that that's just going to hold back growth. This is a very slow way of growing a company and kind of expanding, and all your competition are going to be outgrowing you and kind of leaving you behind, because it's just going to take too long to generate enough profit to continue to buy these new assets and to invest into the business. What we want to be thinking about is, if my business is making, say, 20 grand a year in profit, it's going to take me 10 years to get to 200k. Once I've got that 200k, that's when I can buy these bits and pieces and, you know, look at these other things. 10 years is a long time. If I could go to a lender and get 200 grand today with a very low interest rate, which at the moment they're not too low, but they're still fairly low, you know, 8-10% is good, then that's just going to accelerate my growth. I'm going to be able to implement these strategies ASAP, and as I grow, the company will get more profits, and those profits will pay off the loan, and with the increased profits, that gives us working capital then that we can reinvest back into the business. So it's just accelerating that whole growth plan in your company. One of the things as well that holds back business owners from taking out these loans is that they just simply don't want to pay the interest. They just feel that paying someone in interest is just something that they just can't get their heads around. And do you know what? I think that's crazy. If you'll give me, you know, you'll give me 200 grand, and all I've got to do is give you back, like, say 8%, let's say 10% at the worst. So I've got to give you back 20 grand, and you'll give me 200 grand for 5 years to pay for all the bits and pieces that I need. It's a no-brainer in my eyes. By taking out these loans, you're paying a small fee, or what we call interest, and that's just going to help accelerate your growth and create wealth for you and your family through your business. So the second point now is how to access finance to get that into your business to help fund all these things we've been talking about. And in the UK, we need to be trading for at least 2 years for most lenders to kind of look at borrowing money through your business. So if you've been trading for more than 2 years, then it definitely helps if your business has been profitable in those 2 years, because lenders are going to see that as attractive and less of a risk. If it's not been profitable, then it's not the end of the world. It just means that generally borrowing costs will be higher, so there'll be a higher interest rate charged. It's best to use a broker as well to check the whole of the market, because a broker will be able to tell you what kind of finance you've got access to and what actual finance you'd need depending on your situation, whether it's a standard loan, whether it's asset-backed finance, or whether it's a credit card. Your broker's going to help you out. And if you need assistance with any of that, then I can help as well. Feel free to get in touch with me. I've got access to a number of brokers, a number of lenders, and I can certainly steer you in the right direction of who to speak to help your business with its finance needs. Have a look at all your income and outgoings and just see, you know, from a very high level, whether you are going to be able to afford to repay the monthly repayments on that loan. And make sure you allow for inflation in your costs. So factor in inflation, cost rises, and also that some borrowing comes with borrowing costs. So just make sure that they're factored as well, and that your business is able to pay for all these. So now let's look at the types of borrowing we can get into the business. So your standard loan is your typical loan that you see probably personally as well when you take out a loan, and it's borrowing your business a fixed amount over a set time frame. So it could be that I need £50,000 and I need it over 5 years. So that's pretty much as simple as that. What the lender would do then is just charge interest on top of that. And generally for a small amount like £50,000, it doesn't necessarily need to be secured. So most lenders would be quite willing to give that money to your business to help finance your growth or sort of pay for your assets or whatever you need. An overdraft is where you agree a fixed amount that your bank balance can go overdrawn. So if you've agreed, say, £20,000 as an overdraft and your bank balance is at zero, then that's fine. If all of a sudden you've got to pay £10,000 out to a supplier and your bank balance is now going to go overdrawn by 10,000, then that's still fine because you've pre-agreed a £20,000 limit. So the way that banks would normally work is that they'll charge you once you go overdrawn. So there's normally some kind of fee for having that overdraft in place, and then once you go overdrawn, then they'll charge interest on a daily basis on the amount that it's overdrawn by. So if you're at zero and you spend £10,000 and it's overdrawn for 10 days, then you generally pay whatever the percentage is for those 10 days. And then once you've got money back in the business through one of your clients paying you an invoice, then once that's repaid and back to sort of zero or back into a positive figure, then that means that interest stops being charged then at that point. So that's kind of how an overdraft will work in the business. We've then got asset-backed finance, which is another easy way of raising finance for your business. And generally what you're doing is looking to buy some kind of asset, whether it's a van, whether it's a piece of plant or machinery. And because there's a physical asset there, the lender is securing the borrowings against that asset. So they're generally more comfortable to kind of loan money to you and your business because they've got collateral there with the asset that they're kind of financing. So generally they'll have title of that asset until the moment it's repaid, the loan's repaid. And then once that loan's repaid, that's when the company takes title of those goods or those assets. Invoice finance is another way of getting some quick money into the business, but it is a very, very costly solution. So be very careful and look at the costs involved before looking to go down this route. But effectively with invoice finance, once you've raised an invoice in your business to one of your clients, then the invoice finance company, the invoice factoring business, will then settle that invoice for you. So it's a way of getting cash into the business quite quickly. If you're working with clients that generally pay 60 days, 90 days, then it's definitely a good option. And as I say, just be careful because it can be quite expensive to go down that route. Credit cards is a good solution. So if you're used to paying immediate payments for items, so if you're going to a local wholesaler or going to a cash and carry and you're paying cash instantly, then having a credit card is a good way of getting some finance into the business, getting some payment terms. So generally a credit card will be paid every 30 days. And if you kind of time it right, then you're able to kind of get 40-day payment terms on some of these purchases. So again, it's just a good way of extending finance to help you with your working capital during certain periods. And I'd always advise using a credit card rather than a debit card or cash, just purely because you get those payment terms. The cost of having a credit card is fairly cheap. I think with businesses, it's very much just a annual fee of between kind of £50 to £80 a year. So very cheap way of gaining access to credit. If it's something that's needed to plug a very short-term cash flow issue, then why not use it? You've got the facility there, so that's better than the alternative. So if you want to ensure your business gets through this year and sees it as a successful year, then look at raising finance in your business as a viable option going forward. Get in early to beat anticipated rate increases, and by utilising debt, you'll be given cash for a very low fee in order to pay for all the growth and development your business needs. This will allow you to focus working on your business as the entrepreneur and get you one step closer to your journey of growth, with the final destination being the wealth creation station. And don't forget to hit the subscribe button to this channel. And if you enjoyed this video, then check out this one here, where we go into a bit of detail around the employee mindset, entrepreneur mindset, and how we can grow our companies and kind of get out of these restrictions that are holding us back. Thanks for watching, and I'll see you again soon.